Today, on Tuesday the 11th of August, 2026, the euro is trading firmly at 2-month peaks against the dollar, hovering around the 1.1560 level. That is the strongest we have seen since early June. Yet here is what makes this move fascinating: the traditional yield gap still points in the dollar's favor. Typically, higher US interest rates attract capital and keep the greenback bid. But right now, that relationship is breaking down. The euro's appreciation trend is overriding the carry trade logic. Commerzbank calls this a gradual appreciation path, and when one of Europe's largest lenders uses that phrase while also reporting record half-year profits, we need to pay attention. The market is telling us something about real rate expectations, risk appetite, and a potential structural shift in dollar dominance. Commerzbank itself just posted a staggering first-half 2026 result. Revenues climbed 7% to €6.5 billion, and net profit soared 40% to €1.8 billion. These numbers matter because they reflect not only a strong banking environment but also an institution willing to back its currency views with real capital. Meanwhile, the European Central Bank continues to price in a hawkish stance, as MUFG recently highlighted. Higher-for-longer interest rates in the Eurozone support the euro by closing the real rate differential with the United States. Add to this the analysis from Commerzbank's Volkmar Bauer, who argues that an end to the Iran conflict and a reopening of the Strait of Hormuz could remove a key dollar safe haven bid. The combination of domestic strength and fading geopolitical risk premium creates a powerful tailwind for the single currency. For anyone importing goods into the Eurozone, this appreciation is a welcome relief. A stronger euro makes dollar-priced commodities like oil and raw materials cheaper, directly easing input costs. It also helps dampen imported inflation, which aligns perfectly with the ECB's price stability mandate. On the trading desks, the move is forcing a rethink of short euro positions that dominated the first quarter. The Wall Street Journal Dollar Index has slipped to near 96.17, its lowest in 7 weeks, confirming that dollar weakness is broad-based. We are even seeing the Chinese yuan hit 6.91, its strongest since May 2023. So the euro is not rising in isolation, it is part of a coordinated move against the dollar, and that strengthens the technical picture considerably. Commerzbank's base case is not a sharp spike but a steady, grind-higher trajectory. Today's FX Street piece explicitly titles it a gradual appreciation path. Why gradual? Because the yield gap will not vanish overnight, and the Fed has room to push back. However, real rates, adjusted for inflation expectations, are already turning in the euro's favor. Moreover, if the Strait of Hormuz reopens and oil prices stabilize, the euro could get an extra geopolitical boost. We have to keep an eye on the next resistance at 1.1600 and then 1.1750 later in the third quarter. But the message from Commerzbank's trading floors is clear: sell dollar rallies, buy euro dips, and look for the trend to extend into the autumn. The euro's 2-month high is not a headline anomaly, it is backed by record bank earnings, a hawkish ECB, and a fragile dollar across multiple pairs. Commerzbank's gradual appreciation call reminds us that currency moves are often slow and quiet until they are not. Watch the real rate spread, watch the Strait of Hormuz, and watch how the ECB communicates in the coming weeks. If the current path holds, we could be talking about 1.17 or higher before the leaves turn. For traders, importers, or anyone converting holiday money, this trend deserves a spot at the top of your watch list.